100 tons are gone. Physical gold, real bars, pulled from exchange vaults, not transferred between accounts, not moved to other storage, gone from the system, shipped away. While paper gold keeps trading like nothing changed, futures contracts clearing, ETF shares moving, prices looking stable. But in the vaults that are supposed to hold deliverable gold, the registered storage that backs all those paper claims, the metal is disappearing. And if you're holding paper thinking it represents actual gold you can claim whenever you want, you need to understand something right now. That gold is already being claimed by someone else, and they're taking physical delivery while you're still holding promises. Gold trading was supposed to remain liquid this month. Orderly settlement, normal processing, the standard flow where contracts expire, some settle in cash, a few demand physical, and the system continues. Except the physical deliveries aren't staying few. Someone is demanding metal at scale, standing for delivery, taking actual bars, and removing them from exchange control entirely, not keeping them in allocated storage, not leaving them in the system, shipping them out to private vaults, to sovereign storage, to locations outside the exchange network. And every ton that leaves is a ton the exchanges can't use to satisfy the next delivery request. This shouldn't be happening. Exchange vaults are supposed to be stable, a reservoir of physical gold that backs the entire paper trading system. The inventory fluctuates, some days more, some days less, but it stays within a range, stays sufficient, stays deep enough that delivery is never a concern. Because most contracts settle in cash, most holders never take physical. Most participants trade gold as a financial asset, not a physical commodity. The whole structure depends on this, on physical delivery being rare, on most gold staying in the system, on the paper market operating independently from physical constraints. But someone just violated that assumption. Someone is taking delivery systematically, aggressively, pulling 100 tons from exchange control. Not over years, over weeks. The drawdown is massive, visible in vault reports, undeniable in the inventory data. And the exchanges that used to hold thousands of tons, enough to satisfy any reasonable delivery demand, are watching their registered inventory drop toward levels where delivery becomes difficult, where the next large request might not be satisfiable from available stock, where the paper market and the physical market stop being fungible. The timing reveals intention. No crisis triggered this, no price spike, no market panic, just quiet, persistent accumulation during normal trading. Someone positioned, decided, committed to extracting physical gold while it was still available at paper prices, while exchanges still had inventory, while delivery was still possible without alerting the broader market. And they're succeeding. 100 tons removed, and the paper market is still pretending the inventory is abundant. Still trading as if physical delivery is unlimited. Still pricing gold as if the vaults are full. This keeps happening. Every delivery period shows more metal leaving. Every vault report reveals lower registered inventory. The pattern is accelerating. And the bullion banks that facilitate this market, that write the contracts, manage the ETFs, operate the storage, are trapped. They can't restrict delivery without admitting the physical is constrained. They can't source replacement metal fast enough. They can't stop writing paper contracts without triggering questions about why. So they continue, selling paper, processing deliveries, watching inventory drain, hoping the accumulation stops before the system breaks. Paper claims keep trading while bars are shipped away. That's the disconnect. On exchanges, gold moves electronically, instantly. Millions of ounces trading daily. But in the physical world, gold moves slowly, carefully, in secured transport. And the gold that's leaving exchange vaults isn't coming back. It's going to holders who don't trust paper, who want possession, who understand that ownership means having the metal, not having a contract that promises the metal. And while they take physical delivery, the paper market continues trading claims on gold that's already gone. This benefits someone. Central accumulators are winning. Sovereign entities that see the leverage in the gold market and are exploiting it. Private wealth that decided paper exposure isn't enough. Institutions that understand when paper and physical diverge, physical wins. They're extracting real metal at paper prices, paying futures market rates while physical premiums are emerging elsewhere. And every ton they remove makes their position stronger, makes the remaining physical more valuable, makes the paper claims on that physical more questionable. The insiders who saw this developing moved early. They positioned when registered inventory was higher, when delivery was routine, when exchanges weren't scrambling, and now they're holding physical gold while the exchanges explain settlement delays, while bullion banks search for replacement inventory, while paper holders discover that conversion to physical isn't as smooth as they assumed. The smart money converted months ago, before 100 tons left, before the drain became obvious, before the fracture started showing. This hurts you. If you're holding gold ETFs, you own shares that represent claims on gold stored in exchange vaults, vaults that just lost 100 tons. If you're holding futures contracts, you're exposed to a delivery system under stress. If you assume your paper gold is equivalent to physical gold, you're assuming the exchanges have enough inventory to convert your paper whenever you want. And that assumption is being tested right now. Tested by accumulators who are draining the physical. Tested by delivery demands the system wasn't designed to handle at scale. Tested by the gap between how much gold trades on paper and how much gold actually exists in deliverable form. Here's the mechanism destroying you. The gold market is leveraged, heavily. 1 ounce of physical gold backs multiple paper claims. ETF shares, futures contracts, allocated accounts, unallocated positions, certificates, they all represent ownership of the same underlying metal. The leverage is invisible when everyone holds paper. But when holders start demanding physical, the leverage becomes visible. The multiple claims on single ounces become obvious, and the holders who request delivery first get their gold. The holders who wait discover the gold is already gone. Settlement delays multiply quietly. That's how you know the stress is real. Delivery that used to process in days now takes weeks. Explanations emerge about vault logistics, about transport scheduling, about regulatory procedures. Each delay sounds reasonable individually, but collectively, they reveal a system under strain. A system that's struggling to match delivery requests with available inventory. A system that's buying time while searching for metal to satisfy obligations it already wrote. 2 gold markets are forming at once. The paper market where gold trades as a financial asset, liquid, efficient, electronic. And the physical market where gold trades as a commodity with delivery constraints, where premiums emerge, where wait times extend, where availability becomes unreliable. The 2 markets are supposed to be connected, supposed to be the same thing, but they're diverging. And the divergence accelerates every time someone takes delivery and removes metal from the system entirely. This won't stop, because the pressure only builds. Accumulators who took delivery aren't returning metal. They're holding, storing outside exchange control, in locations the exchanges can't access, which means the inventory drain is permanent. The 100 tons that left isn't coming back. And if accumulation continues, if more entities decide they want physical instead of paper, the registered inventory drops further. The delivery system strains more. The gap between paper abundance and physical scarcity widens. The exchanges can't replace what's leaving fast enough. Mining output is fixed, allocated, contracted to existing buyers. Central bank gold isn't for sale. Private holdings aren't liquid. There's no hidden cache of gold waiting to refill exchange vaults. The metal that's leaving is leaving permanently. And the paper contracts that you're written assuming most would settle in cash are now facing delivery demands the system can't meet without depleting inventory to dangerous levels. The next large delivery notice forces a choice between cash and metal. More contracts are coming due. More holders will decide whether to settle in cash or demand physical. And if even a fraction choose physical, if the delivery requests continue at current pace, the exchanges face impossible math. They can deliver what's requested and deplete inventory below operational minimums. Or they can restrict delivery and reveal the system is fractured. Either way, the paper market's claim that gold is abundant becomes undeniable fiction. This feels like the moment gold stops behaving like a financial asset. For decades, gold traded primarily as money, as a hedge, as a portfolio allocation. Paper gold was sufficient because the financial characteristics mattered more than physical possession. But something shifted. Someone decided financial exposure isn't enough. That paper claims won't hold value if physical becomes scarce. That real ownership requires possession. And that shift is draining the exchange vaults, removing gold from financial system control, returning it to its role as a physical commodity that must be held to be owned. The bullion banks face exposure they can't hedge. They're intermediaries. They facilitate gold trading. They write contracts. They manage storage. They profit from the spread between paper and physical. But their model depends on leverage, on writing more paper than they hold physical, on most contracts settling in cash, and that model is breaking. When accumulators demand physical at scale, when 100 tons leaves the system, when inventory drops toward critical levels, the banks can't cover. Can't deliver what they've promised without sourcing metal at prices that destroy their profitability. You're holding paper in a market where physical is vanishing, where 100 tons have left exchange vaults while you weren't watching, where the inventory that's supposed to back your claims has been systematically drained by accumulators who understand that paper and physical aren't equivalent, and you're positioned as if conversion will happen smoothly. As if delivery is available on demand. As if the exchange vaults still hold enough gold to satisfy every paper claim that might want to become physical. Gold cannot be simultaneously abundant on paper and scarce in vaults. That's not a paradox. That's leverage. That's the gap between what's promised and what exists. That's the fracture forming right now between the paper market that trades millions of ounces daily, and the physical market where 100 tons leaving causes systemic stress. One of those markets is lying, and it's not the physical market. Physical gold either exists in deliverable form or it doesn't, and the vault reports are showing it doesn't exist in the quantities the paper market suggests. The accumulators who removed 100 tons aren't done. They're watching, calculating, deciding whether to press harder, whether to demand more delivery, whether to drain exchange inventory below the point where the system can function, because they understand the leverage, understand that every ton they remove makes the next ton more valuable, makes physical gold scarcer, makes paper claims more questionable. They're not accumulating for investment returns. They're accumulating for strategic position, for control over an asset where physical availability is becoming constrained while paper claims remain unlimited. Every delivery that's processed depletes inventory the exchanges need for future deliveries. Every ton that ships out is a ton that can't satisfy tomorrow's demands. Every holder who converts paper to physical makes conversion harder for the next holder. The system is cannibalizing itself, using remaining inventory to satisfy current deliveries while making future deliveries impossible. And the paper market is still writing contracts, still selling ETF shares, still promising delivery to holders who have no idea the inventory is draining. The registered vaults that held thousands of tons now hold hundreds. The buffer that used to absorb any delivery surge is gone. The margin of error that kept the system functioning is eroded. And the exchanges that operate this market are in an impossible position. They can admit the inventory is constrained and trigger panic selling in paper gold. Or they can continue operating as if nothing is wrong and hope the delivery demands decrease before the inventory runs out. There's no good choice, only choices that delay the inevitable or make it immediate. You're watching gold, the asset that's supposed to be universally liquid and deliverable, reveal that most of what trades isn't actually deliverable at all, that the paper claims vastly exceed the physical supply, that the leverage is real and the fracture is happening. And you're holding paper claims in a market where physical delivery is becoming unreliable, where 100 tons can vanish without triggering margin calls or delivery failures or exchange halts. Because the system is designed to hide the leverage until the leverage breaks the system. The next large delivery notice is coming, another contract expiring, another holder deciding between cash settlement and physical delivery. And the exchanges that just processed 100 tons of withdrawals have to process more, have to deliver from depleting inventory, have to explain why settlement takes longer, why delivery windows extend, why the gold that's supposed to be stored in registered vaults isn't as available as the paper market suggests it should be. The fracture is widening between paper abundance and physical scarcity, between electronic trading and actual delivery, between what the market promises and what the vaults contain. And every ton that leaves makes the fracture more obvious, makes the leverage more visible, makes the moment when paper and physical completely decouple more inevitable. You're holding paper gold, thinking you own an asset you can convert to physical whenever conditions require it. But the entities that already converted, that already took delivery, did it when conversion was still possible, before 100 tons left, before the vaults were depleted, before the exchanges started explaining settlement delays. They converted when you could have converted, and now they're holding physical, while you're holding claims on metal that might not exist in deliverable form when you finally decide you want it.